This is one of the craziest trades I've been in. We're up about 250 points with a 10-point stop loss. That is a crazy 25-to-1 ratio. It is a mad trade. Look at it, and I'm not coming out until price goes over this line here. When price closes over this line, then I'm coming out. Other than that, I'm staying in. We came up here, 10-point stop loss, and we've come down 268 points we're in. That's all I've been doing today, just waiting to see what happens. I usually do one-to-ones, but I just thought, let me just sit on this one and see what happens. This is a crazy trade, and I really just want to just take the profit. I just want to take it and go. But anyway, let's see how far we can get with it. We have now just reached just over 300 points in profit. 300 points in profit. 30-to-1 ratio. Right, you see what it's doing now? 33% spent on the candle. If it closes above this moving day average now, then it's time for us to leave this fantastic. One thing I do not want it to do is to just drive itself right up. I'm not going to have that. We got 40% spent on the candle. I'm not liking that. I might have to just come out now. Might as well. There's nothing more to do. We've got quite a fair bit of money out of this one. We're just going to jump out. It's no problem. We're out. That was a beautiful trade. Beautiful. That bullish candle was getting a bit too strong for me. I don't know what it's going to do, but other than that, we stayed in longer than I've ever stayed in. But you can see why I stayed in. Look at the difference. Can you see the difference in candles? None of them done this. Not one of them. Look at all the candles. Every one of them respected. Every one of them. Anyone that threatened, look, this one threatened, it didn't go over it. These ones barely went over, look. But they just retracted. All of them were great. This one here was a bit of an iffy one, this here. But other than that, it just continued to give. And that's that. Now this one is, you can see the candle's completely different. You can see it's kind of acting as if it wants to be a bit more bullish. So we came out. We could have come out anytime. Anytime from a 1-to-1 we could have come out. But we just stuck in there and it took it all the way down to this area. And I think that was one of the best trades I've done. It was really good. These kind of sell-offs usually happen when there's some sort of news event or something like that. They don't happen all the time, and most of the time people don't catch them. They hear about them and then look and see the price is gone and they didn't benefit from it. That's usually what happens. But this time we caught the trade, we caught the trend, and we stayed in. 280 points from a 10-point stop. The candle has closed over the 9-day moving average, so we made the right decision. It was a bit too fierce for me. It might come back down, but we don't care. That was the decision I made. If it goes any part here, if it closes above it or if it gets a bit frisky, we're coming out. Right, how did we do this trade? Let's break this trade down so that we can have it as part of our arsenal. Now, we came in on the trade around this area here. We got a signal around that area, jumped in, put our mental stop just above the signal candle and followed it down. Initially we would just take a 1-to-1, but because of the actual hue of the market, we hung around a bit. Now the price kept going down. We could have still come out at this end here, but we put down now the 9-day exponential moving average. This is an exit moving average. We use it for exits. So we'll put this in, and when it goes above the moving average, we will exit. However, as you can see, we did not exit here. That's where we should have exited, but we did not. I left it because it was under the 200-day moving average. If you want to use the 9-day moving average to exit a trade, do not use it before 20 to 30 candles have gone by from your entry point. That's the point people miss. On my back testing, that's what I've noticed, that if you want to use an exit strategy like that, you have to give the candle some time. Once they've got their time, now you can see we're in the game. We weathered that storm here. This is a storm as far as I'm concerned. We weathered it and it came down here. This is the first candle which kind of gave us a bit of courage. And from then, all you do is monitor. All you do is monitor. Look at what happens. The 9-day moving average does not falter. Look, it doesn't, it respects it completely. Look at the resistance. Look how much resistance it's got. It just completely respects the 9-day moving average. It continues to respect it, and we continue to monitor it. You keep monitoring it, and that's all we've done is monitor. As you can see, look, it keeps going. We monitored it all this way down until we came out, which was this candle here. This is the candle which it actually did not respect it. Look, it popped out and it closed above the 9-day moving average. Now it's doing its thing again. It probably can go down a bit further, but we'll have to find another point of entry and then try again. But can you see, once it weathers the storm, once we weather the storm at the early stage of entry, just follow it down and make sure it's underneath the 9-day moving average. But you have to monitor it. I don't know if bots can do it and stuff like that. I suppose they can, but there's nothing better than your eyeballs. So that's the way it's done. That's how you can get these big hauls. But it's difficult. It's something that you've got to learn. You've got to learn it, and you've got to kind of be patient with it. But the rewards are incredible. Let me give you another tip why I actually stayed in the market. Let's have a quick look at the hourly chart to see some analysis. This is why we had confidence in staying in the market. Our entry point was around this area here on the hourly chart. That's where our entry was, on the hourly chart. Now the reason why we wanted to stay in, or we had a bit more courage to stay in, is because now this area underneath the 200-day moving average is what one would call a seller's market. The bears are in play. The bears are in play. You can see that it gapped down. There's some massive news that happened whereby the price gapped down, went past, it went beyond the 200-day moving average, went beyond it again with this candle, rejected the last price here, went back up and went over the 200-day moving average. It tried to become bullish again. That was rejected again and it came back down. That is the key, because it was selling, it tried to be bullish, and then that bullish movement was rejected. We saw a massive opportunity here, and on the 5-minute chart it was the same. So it all looked bearish to us, so we thought, let's just follow it down. And look how far it went down. Look how far it went down. It's not easy to catch moves like that. It's just not easy. But these are the tools that we used to achieve such a thing. So going back to the 5-minute chart, you might ask, I haven't got any indicators that I trust, or I don't have the indicators which are displayed on the screen. Fair enough. Okay, let me show you how you can get into this without an indicator. With that, you have to just scroll back a bit. Scroll back. Look at the price action to the left here. This is the area where you're looking at. Here. You look at the resistance here. is rejected pricing here and here. So you would see what's going on. You see the bullish momentum. There's a bullish movement here. If you look here, you've got bullish movement here. It goes up. However, the price is trying to get down. You see how much resistance and all the spikes is going on here. So you make a note of all of these spikes. These spikes are very important. All these wicks, they're important. So just see how the price is being rejected in these areas here. It's rejecting. It wants to go down, but it's not going down for some reason. The bulls are in power. So you take a note of this area. You could draw a box around this area, right? That's your area. That's where you believe if the price goes into this area, you might get a decent sell out of it, right? So you follow the market and keep watching. It spikes into it again. Keep going, keep going, keep going. And then look in this area here where we were, where our point was around this area here, our point of entry. If you look, you can see that we get into the box. Look, see that signal there? That's our signal, but it's got into that box with a nice decent candle. That's a nice bearish candle, and it does it again. This one's fuller. That one's even better. That's full into that box. But this one, you would probably come in on this one without an indicator. That would be your way more confident candle to come into the market. Now you are coming on that candle with that analysis. All it is the wicks. Watch the wicks. They're important. These wicks are saying we want the price to go down, but for some reason it's not going down. So once the price does go down, like it did with a full candle like that, you can enter the market. Put a decent stop loss, a tight one. You'll put a tight one around here, just above it. The price should not go above this area again. If it does, you are wrong. If it doesn't, you are right. It's as simple as that. Then you follow it down, and then you do what we just said. Give it a 20 to 30 candle, stormy weather kind of thing, and then you would enter your 9-day moving average and just follow it down. You just follow it down, and once it stops giving, which is here, you jump out. It's as simple as that. So it can be done without indicators if you want. And if you need any more questions answered, just let me know.